Hi everybody, welcome to another update on the Gold Forecaster Index, the holy grail to predicting gold prices. In my last video, I said avoid bonds, avoid stocks, and stay in gold, even though gold isn't that bullish. So what is our performance since last month? Gold has won, okay? It only went down 2%. Bonds were the worst. They're down 6%, and stocks are also down 3%. So I win again. Gold has won against stocks and bonds, and we're going to see that bonds and stocks are going to keep crashing. So let's look at the Gold Forecaster Index, the holy grail that is using leading indicators to predict the gold price. That's the red line, and you can see that the red line is moving up for this month. Not positive yet, but it's headed to the right direction. So at some point we will reach positive territory and then it's off to the races. So we're not there yet, but I will keep my gold till the roll rate is still from Q2, so nothing changed. Misery index is starting to rise. Unemployment rate is also rising, so that's very good for gold. Also, the inflation rate is rising again. So good for gold. This is still old data. GLD stock levels are still going down. That's not good. We need the institutional buyers, but apparently they are not buying. Not sure why. Comex the same, going down. LBMA also going down. So institutions are not buying. China gold demand is high, so I'm relieved that the Chinese are buying again in the latest month. So hopefully this trend goes back up. Silver not so much. And SLV is also not doing well. Institutions are still selling silver. PSLV actually managed to go down in ounces, so it's not looking good for silver either. Premiums are also very low for silver. I still believe in this scenario. Bond yields rise, gold will rise as well, but we need to zoom out a bit. It will take a few months, maybe even years for it to happen. US Mint sales have risen a bit, not a lot, but that's a good sign. Interest is coming back in gold and silver. As I said, premiums are not that good for silver. Upmakes junk silver as well. Very low premiums, that's not good for silver. On the other hand, Shanghai is doing very well. Shanghai gold premiums are doing well. At 2.5, that's actually at the high end. So whenever that happens, gold will have a bottom. So this is a bottom going higher. This was a bottom going higher. This was a bottom going higher. So every spike here is a bottom that is going higher, and I don't think this time will be any different. Gold will go above 2000. Actually, even silver premiums, yeah, it's still very low for the Shanghai silver premiums. So I like gold more than silver. COT report is actually bullish. So this is going to come back down to the historic level, which means gold needs to go up. Same here, needs to go down to the historic level, gold will go up. Silver not so much, it's already on neutral territory here as well. So gold is looking better than silver. Lease rates, same here. Lease rates are looking very good for gold. I don't think this is a glitch because it's already 3 days that it's like this. So that means that if this comes down, gold will go up to 2000. Silver, on the other hand, is looking very bad. This is crashing. The lease rates are crashing, which means there's too much silver. If this rises again, then silver is headed to 2022. That's my target. So I would not be in silver minus at all. Swiss franc is actually doing very well. Tips still very bad, but gold is holding on. If this starts to rise again at some point, then we are off to the races. Real yields also positive, so gold is hanging on. Seasonality, we are in September. This should be a very good month. Yeah. This should be good for gold this month. Even for silver normally. But the fundamentals are not that good at the moment for silver. Miner sentiment is pretty bad. It's at the bottom, which means sentiment can change again and then we will head up. So being a contrarian is very good at this moment, but buy the good gold mines, not the crappy ones. This tells us what the inflation is going to do. 30-year versus 10-year. Still flat, but I think it's rising. Higher highs, higher lows. So it could move up together with the gold price. Google Trends, how to buy gold. Yeah, it's pointing up for September. That's a good sign. That means gold could go higher. Also, the debt is rising. The debt has hit a new high, almost 33 trillion in debt. And I don't think GDP will be that high. So debt to GDP should move up and gold will follow. Near-term forward spreads tells us what the Fed funds rate will do in the coming months. It's going to go down still, so by 1%. So that means we're still inverted, and when we move back into an inversion, then gold will rise. So being in gold is still a good play. And the rate pauses are coming. I don't think that Fed will keep hiking. Maybe still one hike and then they will pause. And once they pause, stocks will start falling and gold will start rising. That's what always happens after a pause. So after each pause, stocks fall and gold goes up. That's history. and we just follow history and stay in gold. Here you can see that the Fed funds rates will probably have one last hike, and the 2-year is already starting to come down. So not a lot of rate hikes possible anymore. That's good for gold. This is important. Foreign gold deposits at the New York Fed Bank is rising. So I think that central banks are starting to buy gold. This has never gone up. It's always down, down, down. And only this year it started rising. It started to rise. So that is positive for gold. Here we see the bank term funding program is still very high. So there's still problems in the banking system, and here as well, problems in the banking system. Let's go over the stock forecaster index today because I think stocks are about to crash this month. Now the stock forecaster index is pointing down a bit, still in the positive, but this could go negative very fast. So keep watching this. I think this could go negative. Brave Butter Kelly is also starting to top out, so watch this red line. It's still positive, but can crash very fast. The earnings, that's very interesting. Forward earnings are actually rising for the big companies, but they are falling for the smaller companies. So which ones should we believe? The big ones or the small ones? I think we should follow the smaller ones because they are the real economy. These are more global stocks, and this is more the small businesses, and they are not doing that well. So I think there's weakness coming in stocks. Capex still going lower, and this is an ominous sign. Smart money is leaving like no tomorrow. It's cratering. So smart money has left the building, and the retailers are still in the market, but they will soon find out that stocks will crash by 7% this month. When you calculate it, then here you can see that for this month we will drop 7% in the Dow Jones, and next month we will drop 1%. So I would get out of the stock market. Do not pick up pennies in front of the steamroller. Stay in gold. That's what I advise. Yeah, this means that stocks are not that good value. The upside is maybe 2% at this level, so avoid stocks. Temporary help workers are going down. That's the blue line. So we are going to roll over in stocks very soon. Truck tonnage and sales are topping out. So the green line is also topping out. Yeah, that's a sign that we have a top in stocks. Here as well, the orange line says that there is less deficits So there will be less profits as well with a lag. So this is a bad sign for stocks as well. Liquidity is also moving lower. So these stocks will probably fall off at some point. Bank tightness, all bad for stocks. Yeah, rate hikes will pause, so that's also bad for stocks. Economic surprise index is also falling off, could go to 0. So not looking good for stocks. Even the home builder index is now topping out. It was going up, but now we will see in the following chart that also home builders are starting to get reversal candles. So this could be a topping pattern. Okay, so you get the drift. Central banks still tightening. All central banks are tightening now. That's not good for stocks. Let's take a look at deposits. Deposits are still declining a bit, so that's also bad for stocks. Less deposits is less loans, but loans are actually rising a bit. But yeah, I don't think this will rise too much, so no credit means stocks will fall. Money supply generally going down, also not good. Let's take a look at the deficits. Budget deficits up. Trade deficits. Okay, the services are doing very well. Services surplus, but goods deficit is rising. And this is my favorite chart. Our latest data tells us that the deficits will increase. This is a leading indicator. The air freight's plunging, so that means that the red line will also plunge down, which means higher deficits. Import prices up, export prices down. That's deficits going up. Here, export prices. It's a bit the same here. But import prices starting to move higher. Imports of goods and services. This is for Q2, both going down. So GDP going lower. And I added a new chart here. Deficits are actually correlated to the currency. So as you know, I think that the trade balance, the red line, is going to roll over and start to go back into deficits, right? Because I said so here. This is going to roll over. And that means that the dollar, and this is the dollar, will start to go down. So it is now at 100. Everyone thinks that the dollar will go up. I think the dollar is going to go down in the coming months and years. So it's over. We need to get into commodities and gold. Capacity utilization is actually up. Again, almost 80, so that's inflationary. We will see inflation coming back into stagflation. The path of Fed funds rate is going to go lower, as you can see here. I think maybe a last rate hike and then we are going down in rate. We will have rate cuts next year. So prepare for this. You know what to do. You go into gold and go out of stocks. It's really that easy. Stop trading all the time. Just buy gold miners, buy Soma Gold. And China knows it. They are selling the US treasuries. What are they going to do with that money? Probably they are going to buy gold and commodities and oil. So do what the Chinese are doing. Just buy gold and sell treasuries. Now everyone is saying that China is doing really bad, but look at this. China power consumption has hit an all-time high. So I don't see a problem with China, maybe in the real estate market, but the overall economy is doing pretty well. Growth is there. I think 6% growth is possible. And you can see that from the power consumption. I don't see any problem in China. They also have no inflation. So economy is doing pretty well. This is a nice chart about central bank gold buying. And this is China buying. So as you can see here, these are the unreported purchases, and Kos Janssen thinks that this is what China is buying. So China is buying a lot of gold, and you should do that as well. This is a nice chart. I created this, and you can see that gold is outperforming copper. I think it will keep outperforming copper in the coming months because we are going into a recession. And gold does well in a recession, while copper is, it's probably going to stay flat around this level. Even though I like copper in the future, it's probably not the best investment when we get into a recession. We also had a Sprott Holdings update. Just look at this. He sold mostly the silver and lithium miners. So reduced positions in these silver and lithium miners. And he has done very well because lithium has gone down and silver has gone down. And he bought, mostly gold miners. You can see the holdings here. Now, the last thing I want to talk about today is bond yields. I think bond yields are going much higher. People think that it's going to go down again. I don't think so. They're all positioning into a short squeeze and think that bonds will do well. I think that this trend is just going to keep on rising. And I have evidence. You need to look at the evidence, okay? Not just guess around. You need to look at evidence. And this is crucial. So what drives the bond yields? It is driven by money printing and fiscal spending. If central banks print money and buy bonds, that will drive bond yields lower, okay? If you buy bonds, then yields go lower. Now, what what are they doing now? They are not money printing, they are doing QT, so they are selling bonds. So this has gone down, and that means that yields will go up. Okay, if this goes down, then yields go up. Now this is the TLT, okay, so that's the inverse of the yields. So if this goes down, that means yields go up. Okay, so that's the first thing. Money printing, they are not printing money. So that means yields go up because they are not suppressing the yields. Second thing is the fiscal spending. They are increasing the debt right now. They are issuing treasuries that nobody wants. China doesn't want it. The Fed doesn't want it. Nobody wants treasuries. So you can see that here. That's the deficit. So they are issuing a lot of treasuries, increasing the debt. And as you issue treasuries and nobody buys them, then yields go up, okay? Because you need to give a higher yield so that people want to buy it. So as this goes down, then bond yields also go up. And I have done the sum of these two. So this plus this, and that gives the green line. So the green line is probably following the bond yields. And now you see QT plus bond issuance. So the green line is going to keep on going this way, which means yields going up, and which means TLT, the bond market, is going lower. And that's what we see. We see the bond market going lower. So bond yields actually rising because they are inverted. Bond prices and yields are inverted. And it is rising. I don't think this will stop anytime soon unless the Fed starts money printing and stops issuing debt. So watch for these two things. I watch it for you. That's with this chart. So I have added this chart to the bond forecaster. So you can go to the bond forecaster so that we always know what yields are going to do. I added it somewhere here. Yeah, this one. So here you can just look at the red line, which is the sum of both charts. And as long as this goes down, then yields will go higher. So this is minus the yield. So this will go this way. So keep checking this. This is crucial to understand what bond yields are going to do. So conclusion, what is the conclusion? I think bonds will underperform again. So TLT going lower, stocks definitely going lower. We have seen that with the smart money index, and gold will outperform again. So position yourself, and I'll see you in the next video. Bye.